Hi, everyone. Thanks again for joining me. I wanted to introduce my guest today, Dan Hultquist. He's the author of an annual book called Understanding Reverse, Simplifying the Reverse Mortgage. And he's also an author of several other books on the subject. He's a leading expert, and I'm so happy you're joining me today, Dan. Thank you.
Thanks. My pleasure.
Oh, great. So I have to say, I was a mortgage officer many, many years ago, and I just had this feeling, even though I didn't know really much about reverse mortgages, that they just weren't good. There's something, stay away from those, that looks like trouble. And of course, there was some stories that would pop up, and I don't remember everything about them, but there was something, that was dangerous about them. So I was wondering right off the bat, because, if someone sees the title of this video, they're going to be like, oh, I don't want to listen to that. So those that have tuned in, can you tell us, why there was that perception possibly from me, and maybe what's changed?
Yeah, I can tell you a little bit. Most of the misperceptions and negative perceptions about the product stem from prior to when it was regulated in the late 1980s. So some people still have those old legacy reverse mortgages from the 60s and 70s. They're still alive. They still could have those, but they were unregulated products that weren't really structured. Sometimes they were in the best interest of the client, but they were complicated, unregulated products. It wasn't until the late 1980s that we have what's now known as a home equity conversion mortgage, which is the federally insured product. And so when people think about their grandparents' reverse mortgage, well, those were products that maybe weren't great. They served a purpose, but not the product that we have today.
Okay. And what is it about the changes that are so significant to protect the consumer and so forth?
Yeah, there's a lot of changes that took place as a result of the government's involvement in the reverse mortgage program. One is mandatory counseling, which I know we've talked about in the past, but also there is a insurance policy associated with it that pays for the losses if the home ever becomes upside down. The borrower and the heirs are protected. So all reverse mortgages today are non-recourse loans, which means you're never going to owe more than the home is worth at the time the loan is due or when it's sold.
Okay. I'll talk a little bit about some of my preconceived notions about reverse mortgages. Was that somehow I was going to owe more than what it was worth? That there was no way, there was a way for them to, have me out on the street, that I was going to be homeless, so to speak, right?
Right.
Okay, can you address some of, the non-truth about that?
Sure. By federal statute now, reverse mortgages have to be non-recourse. So it doesn't even matter if it's the government insured product or there are proprietary reverse mortgage products outside of FHA. They are all non-recourse loans now, which means you're not going to owe more than the home is worth at the time it's sold. And so it does offer some protection for the client. The government's involvement offers some protection for the lender too, which allows us to offer the product at very competitive interest rates with outstanding terms.
Okay. So another one was, this is my kid's childhood home, the property they grew up on at. Maybe one of them wants to own it. Maybe all of them want to, still own it. And if I do a reverse mortgage, then I basically handed the ownership over to the lender automatically upon my passing. Is that
right? That's the number one misconception about the product. Like I'm in Atlanta. If I were to walk down the streets of Atlanta and just grab somebody that looks 62 and older and say, why wouldn't you consider a reverse mortgage? The number one response we get in surveys is, well, I don't want to give up title to my home. And that's not the way it works. Now, it used to be back in the 60s and 70s, and overseas, they have what are called equity release strategies where you do give up title to your home. But now with the home equity conversion mortgage product, you actually retain ownership and title to the home through the life of the loan. And even after you die, the heirs can sell the home. They're just going to need to, with the sale of the home, or they can even pay it off if the loan balance is low and they want to do that. But they still have the right to do that. It's just a lien, just like a HELOC, right? Just like a home equity line of credit.
Sure.
So it's just a lien that has to be paid off when the last borrower passes away or leaves the home for 12 consecutive months for mental or physical incapacity.
Okay, so another one is that I think that I, understand that, well, I can't lose the house, but if I sign up for this mortgage, we think of mortgages as we're locked in a contractual way, and I took some equity. I took it in the form of a line of credit, right?
Mhm.
Or I took it in a lump sum, but I mean, I'm hoping that the market will continue to rise, I mean, obviously through inflation alone, right? The home that I, own that's worth 300 is going to be worth 400 in 10 years or whatever, right? We're used to that kind of thing over the long run.
Right.
Am I cut out of that access to that equity? I mean, that's what I'm thinking. Like, I don't want to lock myself into it if it's going to increase. Do I have a chance to go back and grab some more of that additional market equity?
You can, but let me clarify. Let me back up just a second. One thing that you had mentioned about, the potential for losing your home. When we do see negative articles, which are becoming rare, but occasionally we'll see negative articles about the product, it usually revolves around somebody did lose their home and they had a reverse mortgage, but they're not connected. For example, if you don't pay your property taxes, you're going to lose your home, whether you have a reverse mortgage, a traditional or forward mortgage, or no mortgage at all.
That's
And
true.
so,
Need a mortgage.
unfortunately, the major lien holder has to do the dirty work. And so it's rare now because we actually qualify someone based on sustainability. It's a process we call financial assessment. We have to look at their residual income. We have to look at their credit. We have to make a case to HUD that this is a loan that is a sustainable loan for the borrower. And so it doesn't happen very often anymore. But for a while, we had, especially in post Great Recession, we had a lot of people that couldn't pay their taxes. They were losing their homes because that's a requirement, right, of any homeowner. It's not unique to being a reverse mortgage holder.
Gotcha.
But as far as like the additional market value, we're doing a lot of what are called HECM to HECM refinances right now.
Oh.
People got a reverse mortgage in the past, but now their property has increased. We're seeing 7% plus nationwide over the last 12 months. So we're seeing home prices appreciate and interest rates are going down. So I'm looking at my rates today and we're offering reverse mortgages in the 2s. We're offering conforming rates on a product that doesn't have a monthly payment and is a non-recourse loan where you can't owe more than the value of the home. So it's an outstanding value. So we're doing a lot of refinances to capture a little bit more equity if somebody wants to take advantage of their gains on their home price appreciation.
So that is a yes, an affirmative that we can go back and grab some of the additional market.
Now, sometimes you can't. If interest rates go up, borrowers get less on the reverse mortgage. Sure. Even though they're older, and older borrowers generally qualify for more. If interest rates go up, people get less money to refinance. It doesn't make sense.
So right now, actually, then what you're saying is this is one of the most ideal times ever.
Yeah, we're very busy this year.
Yeah.
You think about 20. Oh, go ahead.
Yeah. Well, I was just going to say, you mentioned 62, right? So that's a requirement. Somebody one of the owners has to be 62 for you to be able to get a reverse mortgage. Okay. I'm sort of interested in this idea of, financial counseling, and there's no financial counseling for a traditional mortgage. And one of the ideas is, well, I want to get rid of that payment. So on a traditional mortgage, I'm going to pay it down and I'm going to have, and I've got this equity, but I'm thinking in the back of my mind, probably, that I can access that. I do have some cash there, but because of maybe some of the negativity that surrounded historically around reverse mortgages, and then the huge marketing machine that there is behind the traditional world, is I'm just going to refinance. But you're once again, you're tapping into your money, but now you're on the hook for a payment, and you needed
Hey,
the cash. Like, for whatever reason, maybe you decided you were going to expand your home when you're 62 or 65, or you actually are looking at it as supplementing your income, and at the same time you're going to tie yourself down to a payment. That connection has to be disconnected. And people have to start thinking, yeah, that doesn't make any sense. I need the cash flow, but now I've got to send some $1,000 back a month to the mortgage company.
right.
So that, can you talk a little bit about that? That's the facts.
Sure, you really hit on a hot topic in our industry is why are we putting a 70-year-old in a 30-year fixed or even a 15 or a 10-year fixed rate mortgage, obligating them to a monthly payment? If I were 62 today, I still have a ways to go. But if I was 62 today and I had a mortgage balance, I would immediately convert that into a reverse mortgage for a couple reasons. Number one, the rates are the same. Number
Yeah.
two, I can make a payment on a reverse mortgage that will cause the same amortization curve that you would have on a forward mortgage.
Mm-hmm.
So I have the ability to make payments or maybe make advance payments, and my loan balance will drop in the same way that a forward mortgage could do. But if I get into trouble, if I have to retire prematurely, if
Right.
maybe I have a medical issue or something comes up, there are contingencies that happen when you're in pre-retirement and retirement that can disrupt your financial plan. Well, now I don't have to make a payment. I can
Right.
if I want, but I
Right.
don't have to, and I can stay in the home for as long as I, occupy the home and pay my property taxes, right?
Right, right. It's really about leaving yourself an option. I mean, obviously I'm going to just tell the audience, because I didn't say it up front. This is November 4th, 2020. And obviously in the world, we understand what 2020 has meant. And sadly, the older you get, the more likely you could be asked to leave your job. And now,
Right.
you're only 62, 63, 64. You're not ready to retire. You don't want to retire, but they've asked you to go find something else to do. And you've got this payment, right? And you would have the option, so you could have freed up some of that equity by making payments, but now I have the option, and they say I don't have to pay it back at all, right?
Right. I mean, that's one of the huge advantages is the flexibility. But we're going to tie up a pre-retiree or retiree with a monthly obligation for the next 10, 15, 20, 30 years. It's irresponsible.
Yeah. So were you in the traditional mortgage industry first?
I
Okay.
was.
What converted you?
Yeah.
Because
I
you
was
didn't
in the
make
mortgage.
this easy on yourself. You didn't make this easy, right? Because it's an uphill battle in a sense, right? To educate people about what blind spots they have. Yeah.
Sure.
So
Yeah, I did well on the forward or traditional side. I mean, I'm in the Metro Atlanta area, so
yeah.
I um I did well in the early 2000s, and it's kind of a second career for me. I got into the mortgage space early 2000s, but by 2007, 2008, my realtors weren't selling, my builders weren't building, and I
No.
saw my income potential going down. And I thought, you know what? I have two young kids. My wife has a business that was doing well. Why don't I just spend some time counseling? I'll go downtown Atlanta and I'll help people with their mortgages during the
Mm,
housing crisis.
mm,
You don't do it for the pay. It doesn't pay well. It did give me insurance, which is great.
mm.
But I went downtown Atlanta and I did counseling, housing counseling, nights and weekends. I took the kids during the day, and it was actually a nice time for us. I mean, it was a struggle, I know
Mm.
nationally, But, I'm on these counseling calls trying to help people with loan modifications. I've lost my job. I can't make my mortgage payment. What am I going to do? And so I wound up counseling people every day. I ran into a client that was in New York. He only owed about $9,000 left on his house on Long Island. So you can imagine how valuable that home is.
Right.
But he owed 2 years of back property taxes. So yeah, New York is I think it's a judicial foreclosure state. So he had a little bit of time, but I can't seem to get this guy a loan modification. And I just yelled out one night at work. I said, why the heck can I not use this guy's housing wealth to pay his back property taxes? He has that much equity in his home. It makes absolutely no sense. And I was so frustrated with the lender I was working with. And a guy from across the room said, do you have any idea what kind of counseling we do on this side of the office? And he was a reverse mortgage counselor. And I was opposed to the product. I didn't like it. It just smelled bad to me, but I didn't know why. So I began to ask questions, and I said, you got to be kidding me. He's 65-year-old veteran. He can do this. So we wound up setting him up with reverse mortgage counseling, saved his home, paid off his $9,000, paid off his property taxes, gave him a initial draw that was pretty sizable to pay off some consumer debt. So he's debt-free other than the reverse mortgage. We gave him a monthly payment with the reverse mortgage. I think it was about $300 a month, just wired to his bank account every month. And he had a line of credit for emergency purposes if he ever got in trouble again. We did so many things for this client in a very short period of time. I said, I'm sold. I've never seen a product like this that can change someone's life so quickly. Now, he was a needs-based borrower. That's actually a smaller portion of what we do now. But I've never seen a product change someone's life so quickly. And I said, I know what I want to do when this housing crisis is over.
Yeah, because it wasn't just about the time and crisis. This was a way to really protect everything, but also put them in a much better. Well, the fact is that when you lose your job, you can have all the equity in the world, but you don't have the ability to repay, right?
That's right.
So they look at it differently when they're looking at it reverse mortgage wise. They're saying, well, can he still make his homeowners insurance payments? Can he still make his real estate tax payments, right? And
Right.
it's not the same. Can you talk a little bit about that?
Yeah, that's a good question, because in his situation, back then, he just needed to be 62 or older and have sufficient equity, and we're going to close that deal very quickly. In 2015, we rolled out financial assessment, where we now have to look at, okay, well, long-term, is this sustainable for him? And in his situation, it would have been, because I'm going to give him a $300,000 line of credit that he can use for emergency purposes. We can actually make a calculation that shows how much income he could derive from $300,000 line of credit. And now that looks sustainable to HUD. Okay, but right now, if we have a borrower who has a residual income shortfall each month, we give them a reverse mortgage, we pay off their existing mortgage, and they still don't really have a threshold of residual income that HUD wants to see, then there's a couple things that'll have to happen. Either one, we'll have to reject the loan because it's not sustainable. We don't want to put them in a loan that's going to fail in a couple years because they can't pay their property taxes. Or we're going to take a portion of what they qualify for, set it aside, and have the lender pay their taxes and insurance each year to make sure that they don't lose their home.
Really? And how long can that last? I mean,
it's called a life expectancy set aside, but that's really a misnomer. It's based on what I would consider outdated life expectancy tables, but it's still a significant period of time for most of our borrowers. We take the age of the youngest borrower and we have a calculation based on their existing property charges. We gross them up, extend them out over their lifetime, and then discount them back, knowing that that pool of money is going to grow over time. So a typical scenario you might find, unless you're in a high tax area like California or New York, you might find that we need to set aside $20, $30, $40,000, maybe as high as $100,000 for a borrower if they have sufficient equity to pay their taxes and insurance. And then they can have the peace of mind that, okay, I don't have to pay that bill. The lender's going to do that for me. And, they're not actually setting money aside in a bank account like you would in an escrow account. It's a portion of their equity that's earmarked for paying property charges. And it's been life-changing for many people.
Yeah. So, okay, so somebody's watching this conversation between the two of us. They get on Google and they start searching reverse mortgages. They don't get to the videos and see other interviews, people like yourself. And what they see is articles, and these articles pop up and they've got some negative stories about reverse mortgages. And there was one recently that you and I had talked about, and it tied in foreclosures with reverse mortgages, right? So we already talked a little bit about that with, hey, if you don't make your payments, regardless, traditional, reverse, if you don't make your real estate payments, your homeowners insurance payments, you can still lose your home. But I am curious, these get tagged if the lender ends up with the property, right? Because that's the decision that was made by the heirs and so forth, right?
Right.
Because they still had the option to maybe purchase it back. They put it into a foreclosure. Is that true?
Yes, that's a
And so
really
they
good.
get labeled as a foreclosure, and that's a negative connotation, right?
It
Oh
is.
God. So, but that's what's going to happen if the lender takes it. Is that correct?
Yeah, let's discuss that because it's actually first started with a study done at USA Today, and they reached out to me and they said, well, we're seeing, some foreclosures with the reverse mortgage product. Can you please explain that? And I said, well, as strange as it sounds, in the mortgage industry, there are good foreclosures and there are bad foreclosures. And they're like, good foreclosures? And I said, let's take a look at what happens with a reverse mortgage. Your home appraises for this. We give you that amount. We give you a portion of your home's value that you have access to. It could be in a line of credit. It could be in a lump sum in cash. It could be monthly payments. But we're giving you a portion of your home's value up front. You still retain title and ownership, but we're giving you a chunk of money. Now, as that money grows, if your property value decreases, or if you have the reverse mortgage for a very long time, you might find that the loan balance is above the home's value. At that point, when the borrower can stay in the home as long as they want, that's fine. But when they die, the heirs look at it and say, there's no equity here. What am I going to do? Well, in most cases, they're just going to walk away. The foreclosure process is the process by which the lender can recover the home so that they can sell it to recover some of their losses. And it happens a lot. People think, we make a ton of money on these loans. Well, actually, FHA actually loses money on this loan. So the FHA insurance actually pays out more claims than they collect in premiums. And so when that happens, when you sell the home, the lender has to sell the home to recover those losses. They get the home to sell using the foreclosure process, and the heirs are fine with it because they look at the situation and say, Mom and Dad borrowed a lot of money over a long period of time. In fact, they borrowed more money than the home was ultimately worth. Is that a good foreclosure or a bad foreclosure?
Right.
From FHA's position, it's a bad foreclosure because they just lost money on the insurance, right? From the borrower's perspective, we can't ask them because they've passed away. But if we could ask them and say, was that a good transaction for you? Yeah, because ultimately I borrowed $300,000 over a period of 10 years and my home sold for $285,000.
Right.
That's a good deal for the borrower. They borrowed more money than ultimately the home was able to pay it back. And that non-recourse feature protects them. FHA's insurance is there to protect them. But the method that the lender has to use to recover the home is the foreclosure process. Now, I explained that to USA Today, and they said, yeah, but we're seeing this happens more frequently among minority and low income households. And I said, of course that's true. Of course that's true. And they said, what? And I said, you have to understand that the needy are the ones who are more likely to draw every penny they can from a reverse mortgage.
Mhm.
The people that we're originating reverse mortgages for right now for financial planning purposes, they might never draw any money. They want the line of credit as a standby or as an insurance policy or to pay for home care in 20 years.
Mhm.
They might have a reverse mortgage that the line of credit is worth $300,000 and never draw a penny from it. When that loan ends and the heirs look at it and say, oh, all I have to do is pay off the closing costs from when they got the reverse mortgage, I'll do that.
Yeah.
So you're going to find that, yes, this will happen more frequently, that it will end in a foreclosure. But as odd as it sounds, to me, that's an acceptable foreclosure because the borrower got exactly what they wanted.
Yeah. Sometimes my thinking is that you can use this equity, this line of credit as an emergency account that you're referring to. And I just started thinking as you were talking about, you know, parents like to help their children. If their children are in trouble, we want to help them. And they may still be able to make payments, but they would not be able to say, for example, in their own homes, maybe even get maybe they lost their job, right? And they could use a little bit of help, but they can't get any of their equity out right now. But the parents could lend them money if they had lines of credit. This is just how I think, and
Sure.
though the child may be able to make payments, now you could put that money back into your line of credit, pay it back down again,
Yeah,
and
let's
just
address
use
that.
it like a bank, in a sense.
Let's
Just
address
as an
that for a second,
yeah,
because consider the cost of college education right now. Yeah, it's
yeah,
very expensive. And the
yeah.
grandparents are thinking, I don't want to pull it out of my traditional retirement savings because I'm counting on that. I have to gauge, how much I'm going to need over a period of time. So without disrupting my traditional retirement plan, I still have $500,000 in equity in my home that I could use for any purpose.
Mhm.
And so in those cases, yeah, can I pay for a child's education and not disrupt my retirement planning? Yeah.
So you're an advocate of, if you're eligible for a reverse mortgage, when that you'd pass the muster when it came to counseling, everybody should grab a line of credit.
I would, if you're planning on staying in the home. And
Yeah.
here's,
Okay.
if you think about it, if I'm going to sell the home in the next 2 or 3 years, does the line of credit or the growth, the line of credit actually grows at the same rate that your loan balance grows.
Mhm.
So for me, if I'm 62 and I'm looking at a window of retirement, I want to make sure that I'm going to stay in that home for as long as I possibly can, because that's when the reverse mortgage is most advantageous.
Mm.
So if I were turning 62 right now, I'd probably make sure that I buy a home with a reverse mortgage. You can do that.
Oh, really?
That's called a Heckam for purchase.
Mm.
And I would relocate to my final home, the one home that I want to retire in. I would make sure that's the home that I'm using the reverse mortgage on, and then never touch it. Just let the reverse mortgage ride out and use the
Excuse
funds
me.
if I need it.
Yeah. So let's run through that a little bit, because obviously many people I talk to, they're 60. They're not quite there. So maybe you wait till you're 62 to sell that property.
Yeah.
But they're downsizing. Their 6 kids are gone,
Yeah.
or their 4 kids or whatever. They don't need this big monstrosity anymore. They get rid of a lot of stuff. They downsize. They take some of that equity and put it into another property, and then they keep the rest of the cash and do whatever they do with it. But you're saying, hey, you can downsize and do this reverse mortgage. Don't go into a traditional mortgage. I mean, why would you want to if you have the equity, right?
Yeah. Yeah.
So
Let's
you
take
buy
a
it.
typical scenario of a 62-year-old is going to get about 50%
Yeah.
that they could apply towards the sales price of a new home. So let's say I have a on this side, I have the home I currently live in is worth 300,000. Our average is about 300 to 400,000. So $300,000, I can sell that home. Let's say I eliminate some real estate commissions, and we can net gain 300,000 on this home.
Yep.
I can then buy a comparable home, 300,000, closer to my family members, or closer to the beach or the golf course or active adult community, or maybe a condo because I don't want to do the home maintenance, or a townhome because I don't want to do that, or a single story ranch because I don't want to go up and down steps, because of my hip. I can take that $300,000. I could go over here and buy a comparable home in cash with 300,000. I could do that. Or I could do a reverse mortgage, have the reverse mortgage pay 50% towards the sales price. And now I come to closing with 150. I pocket the other 150 and put it in my retirement savings.
Wow.
So that helps me from a cash flow standpoint. It helps to subsidize or supplement my retirement savings. As far as the purchase goes, there's a couple other things you can do that are pretty amazing. Consider there's a trend called silver divorce. Are you familiar with this?
I've heard this term, yes.
Gray divorce, silver divorce. The baby boomers are actually the fastest growing community of divorcees in the country.
It's a beautiful
And
thing.
so what we find is one person wants to stay in the home and the other one says, no, I want a place of my own. The reverse mortgage can tap enough equity to pay the departing spouse their share. So we work with divorce mediators, and they're going to get basically 50% of the equity of this home, which allows them the financial contribution for a HECM for purchase on their new home. Now they both have a home of comparable size, and neither of them has a monthly mortgage payment. So it's an amazing strategy that we've used with divorce mediators, and people walk away from it as happy as you can following a divorce.
Yeah. Yes, it's painful, I've heard. Thankfully, I never experienced that. So a couple things. One is I want to kind of backtrack a little bit
Sure.
on the idea of, there was maybe a time where I don't know if it was the spouse was not on the mortgage, but
Yes.
you were afraid that somehow the spouse was going to be booted out on the street. And can we talk a little bit about that?
Yeah, that was controversial, and it ended up in 2 lawsuits with AARP advocating on behalf of spouses. And here's basically what happened. You have 2 homeowners. One of them doesn't meet the age requirement. Historically, they get moved off of title, and we do a reverse mortgage in this person's name only. And that's historically how reverse mortgages have operated. You're not 62, you're not getting a reverse mortgage. And the mortgagor has to be a borrower, and the borrower has to be a mortgagor, which means they're on title. So we took the non-borrowing spouse off of title and did the loan in one person's name. The problem with that is when that borrower dies, the loan becomes due and payable. So we had to make sure that the spouse was taken care of in another way. It could be insurance. It could be, well, I'm going to sell the home anyway as basically the heir, even though I'm a spouse. I will just sell the home, receive whatever's left on the gain of sale, and I'm going to move in with my daughter, Jennifer. And that's fine. So we saw that happen. The problem is a lot of spouses thought, well, wait a second, this is my home. What are we going to do? And they looked up, and it turns out there's one federal statute that indicated that, yeah, if you're a spouse of a government insured loan, you're considered a homeowner, in quotes.
Oh, yeah. Okay.
And the lawsuits ended with HUD saying, you know what, we really should protect spouses. Let's go ahead and do that. And let's get rid of the negative perception. If you don't meet the age qualification, let's get rid of that stigma and let's just offer some protection. So they do. So let's say you're 62, but your spouse is 55. Well, now the amount that you can qualify is based on the youngest spouse's age, not the borrower, the way we used to do it. It's now based on the youngest borrower or eligible non-borrowing spouse. And so we go down to age 18. Now that's what we call the U zone. Like really? But we have to because we can't discriminate based on age. And so we go all the way down to age 18 where the borrower doesn't really get much money at all. But the biggest gap I've seen is a 74-year-old married to a 47-year-old. It's easy to
Hmm.
remember, but his principal limits are based on her age.
Right.
And now there's a couple hoops you have to jump through if you're a spouse, but upon the death of the borrower, you can actually stay in the home until another maturity event occurs, like failure to pay your property taxes,
Mhm.
or you pass away. So
Yeah.
it's been a really good transition, I think, for spouses, and it kind of got rid of that negative stigma that spouses aren't taken care of. But honestly, prior to 2014, when this changed, you weren't a property holder. You were taken
Right.
off the title.
Yeah.
So when those
It's as
cases
if you
came
didn't
up,
exist, right?
you're
You
like,
didn't exist. Yeah.
right, just because you've lived there for 20 years doesn't mean you're a homeowner.
Right.
And so, there were some struggles with that, but now we do non-borrowing spouses transactions all the time.
Of course. Yeah. So with all these protections, and it is kind of circling back again to this idea that something's wrong with these types of mortgages, is uh, the concept of salespeople or mortgage officers and unscrupulous, people that we have to be protected from because they're trying to take advantage of senior citizens, right?
Right.
Uh, what are the protections, in a sense? What do these mortgage officers have to go through? Obviously, the borrower would have to go through counseling, but what kind of training and what kind of protections in general are there?
Yeah, that's a good question. They still have to have a mortgage loan origination license in their state. So the MLO still has to have a license in the state that they operate.
Mhm.
So that's one protection. But a funny story comes to mind. We go to conferences sometimes with the forward loan originators.
Okay.
Forward loan originators are the ones that are hanging out at the conference bar and dancing and having fun until 2 or 3 in the morning. Reverse mortgage loan originators are in bed by 10. So it's just kind of comical that there's a different mindset. You have more of a counseling mindset if you're in the reverse mortgage business. I've
Mm.
never met a group of salespeople that are more genuinely interested in the well-being of their client than mortgage loan originators on the reverse side.
Mm.
Now, there are some loan originators that excel by doing both
Mm.
traditional and reverse.
Yeah.
Most reverse mortgage professionals that are doing any sizable business, that's all they do. They
Right.
meet at kitchen tables with our seniors and counsel them in many ways. And it becomes, for many of them, it becomes more of a ministry. Here's
Mm.
how I can solve your retirement problems and help you live a more comfortable life. It's
Right.
not about interest rate. I can beat the competitor's interest rate. No, it's not
Yeah.
about rate. It's about the solution. What can I do to customize this program to make you comfortable in your home and age in place?
Right.
So the mindset is totally different. But as far as the protections, they still have to go through mortgage loan origination, safe training.
Mhm.
You've got to keep your licenses up in order to operate.
Yeah. Yeah, it definitely seems like something that, like you said, it's a solution. It's not just a solution of providing cash or purchase, or so I can, I end up with the home or I end up with the cash. It's about this term that's thrown around all the time, financial planning, and where's the plan? But this is literally a plan that can start from the very first time you purchase a home. You can be thinking in terms like you should be counseled about the option of a reverse mortgage at some point. I mean, you're 30 years old and you buy your first home, you and your wife buy your first home, and you're not even thinking about being 62. You can't even imagine being 62. So but
Right.
the idea, we have marriage counseling, we have all these kinds of counseling. Why can't we have counseling about this is an option, kind of plan in that this is Holland Akela, one of your friends in this industry, in his book, he talks about the 3 buckets. And this is,
Yeah.
like you've got your earned income, you got your 401ks, you got your life insurance, and you've got your home equity, right?
Right.
And that is a place you keep putting your money. It's a bucket, right? And think about that bucket is going to be filled up someday, and that you're going to want to draw upon it, just like you're thinking about saving for retirement, wherever you save for it.
Sure.
And maybe have a savings account. You've got buckets to draw from, and knowing what your options are. It just seems like that kind of counseling should happen right at the beginning.
Yeah, I wish it were more mainstream where we did have that type of counseling. I would love to see a day where that actually happens, because we have a lot to say about retirement cash flow.
Yeah.
To your point, Harlan Akla is a close friend of mine. I keep his book handy because he's a very good storyteller, and he gives scenarios on why this makes sense. I'm a nuts and bolts guy. The difference between his book and my book is I go through how it actually operates.
Right.
Here are the nuts and bolts of specifically what a reverse mortgage does and how it does it.
Right.
But he is able to bring it home in kind of a Midwestern sensibility to him. I totally agree with the way Harlan expresses the reverse mortgage options. If you think about it, when you ask most financial planners, how much has someone saved up for retirement? They will look at 401ks, IRAs, pension, things like that. They'll look over here and say, well, they've saved up $500,000 in retirement savings.
Mm-hmm.
Harlan and myself, we look at it and say, well, you have this, but how much is your home worth? And a lot of people look at that and say, well, that's not retirement savings. Absolutely it is. And drawing from here has its costs. Drawing from here has its costs. Now the question is, which one's going to be most prudent? Sometimes it makes sense to draw from your home equity. It's non-taxable, which means you can manage your adjusted gross income. That's how we can save somebody $50,000 in capital gains taxes on a long-held investment, because we keep their adjusted gross income low. So Harlan has all those strategies, all those stories. Fabulous book, by the way. It's called Home Equity and Reverse Mortgages. Mine is called Understanding Reverse 2020. Of course, the 2021 edition will come out in January.
Can you help people find somebody to do a reverse mortgage, or at least to get into those discussions? Can you share that with our audience today?
Yeah, absolutely. There's a couple ways. You can always reach out to me, and I will probably refer you to a certified reverse mortgage professional. There's only 160 of us CRMPs nationwide. So
What?
yeah, there's only 160 that have actually passed the certification exam and become certified reverse mortgage professionals. Harlan's one of them, and he operates nationwide. I work for the top wholesale provider. We do have a retail branch as well that operates nationwide. But yeah, if you reach out to myself, I'll be able to refer you to somebody that's licensed in your state. I don't get paid to do that. I'm not allowed to get paid to do that. So I don't maintain my state licenses. I can talk about the reverse mortgage all day long. I just can't quote rates and terms for specific borrowers.
Okay.
But yeah, you can reach out to me. My website, by the way, is understandingreverse.com.
Okay.
That's understandingreverse.com. And I'd be able to help you. Again, I don't get compensated for that, but I would love to be able to find somebody that can help you or your client.
Well, I'll put your contact information in the notes if that's okay.
Sure.
Video recording. And obviously people can reach out to me, and I can put you in touch with Dan. I don't get any compensation for this either. I just think it makes really good, planning sense. And I really want to thank you. This has been a great conversation, Dan.
Yeah, I appreciate it.
Did you have anything you wanted to add before we go, or do you think we kind of covered it today?
No, I guess if you're interested in understanding reverse, it's available on Amazon as well. So if you're buying one copy, Amazon's probably the way to go. Financial institutions will generally buy on my website because they get bulk pricing.
Okay, sounds great. I hope we get a chance to talk again. This has been a real pleasure and very informative. So thank you, and keep going, keep pushing for this, because I think it's a really good thing for 62 and olders.
Thanks for having me.
All right, Dan, take care.
You too.
Bye-bye.